Earned income. Earned income is money received in exchange for work or services. It comes from salaries, wages, commissions, and professional fees. For most people, this is the starting point of wealth building because it creates the first flow of cash that can be saved or invested. Historically, labor has always been the primary way individuals accumulated resources before owning assets. What makes earned income different is that it depends directly on personal effort and time. It is important because it funds every other wealth-building action, especially in the early stages of financial growth.
Business ownership. Business ownership means holding equity in a company that generates profit. This can range from a small local shop to shares in a large corporation. The idea became more structured during the rise of joint stock companies centuries ago, allowing people to own parts of enterprises without running them daily. Unlike earned income, business ownership allows wealth to grow beyond personal labor. Profits can be reinvested, expanding operations and increasing value. It matters because businesses can scale, and when managed well, they create both income and long-term asset appreciation. Stock investments. Stock investments involve buying shares of publicly traded companies. Modern stock markets developed in Europe in the 17th century, providing a formal place to exchange ownership. Stocks are different from direct business ownership because they offer liquidity and diversification. Investors can spread risk across many companies and industries. Over time, stock markets have rewarded patience as company growth and dividends increase shareholder wealth. They are important because they allow individuals to participate in economic expansion without managing a company themselves. Real estate. Real estate includes land and buildings purchased for living, renting, or resale. Property ownership has been a traditional path to wealth for centuries, often seen as a sign of stability and security. What makes real estate unique is its tangible nature and its ability to generate rental income while appreciating in value. It can also be financed with leverage, meaning investors use borrowed money to control larger assets. Real estate plays a key role in increasing net worth because it combines income, appreciation, and tax advantages in many countries.
Compound interest. Compound interest is the process where earnings generate their own earnings over time. This concept has been understood for centuries and is often described as one of the most powerful forces in finance. It differs from simple growth because returns are reinvested, creating exponential expansion rather than linear progress. Even small amounts grow significantly when given enough time. Its importance lies in patience. The longer money stays invested, the stronger the compounding effect becomes.
Asset appreciation. Asset appreciation refers to the increase in value of investments, such as stocks, real estate, or collectibles. It usually results from economic growth, inflation, or increased demand. Unlike income that is immediately received, appreciation builds wealth silently in the background. Owners benefit when they sell the asset at a higher price than they paid. This mechanism is essential because much of long-term wealth is created not by cash flow alone, but by rising asset values over years or decades. Reinvestment of profits. Reinvestment of profits means using earnings to acquire more assets instead of spending them. This approach has fueled the growth of major companies and fortunes throughout history. Rather than withdrawing gains, investors and business owners deploy capital again to generate further returns. It stands apart from consumption because it delays immediate pleasure in favor of expansion. Reinvestment is crucial because it accelerates compounding and multiplies opportunities for future growth. Diversification. Diversification is the strategy of spreading investments across different assets, sectors, or regions. The principle became widely recognized in modern portfolio theory during the 20th century. It reduces the impact of losses in any single investment. While it may limit extreme gains, it protects overall wealth from severe decline. Diversification increases financial resilience, helping wealth grow steadily even when individual markets fluctuate.
Debt management. Debt management involves controlling liabilities so they do not outweigh assets. Throughout history, excessive debt has destroyed fortunes, while strategic borrowing has helped build them. The difference lies in purpose and control. Productive debt, such as loans used to acquire income-generating assets, can support growth. Uncontrolled consumer debt, on the other hand, reduces net worth. Managing debt carefully ensures that wealth accumulation is not undermined by high interest payments or financial instability.
Financial discipline. Financial discipline is the consistent practice of saving, investing, and avoiding unnecessary spending. It does not rely on complex tools, but on steady behavior over time. Many wealthy individuals attribute their success not to sudden gains, but to habits maintained for decades. Discipline is different from opportunity. It is about how consistently one acts when opportunities appear. It remains important because wealth building is rarely a single event, but a long sequence of deliberate choices.